This video is all about maximizing your portfolio returns by creating or crafting a suitable mix in your portfolio. Now let me ask you a question. If given a choice, would you opt for a less riskier option to maximize your portfolio? Would you do that? Most of you would, isn't it? It's much safer and at the same time it gives you more returns. Well, there is something by which investors like you, me, and all others can capitalize on and get the maximum returns in your portfolio for the amount of risk you're willing to take. Isn't that interesting? We already have something with us which can maximize our returns. In this video, we'll see just that. We'll see how we can maximize our returns for the level of risk you're willing to take. If this is new to you and you want to increase your returns, this video is for you. To know, stay till the end and like and subscribe this channel right away so this video can reach a lot of people. Well, it's commonly understood, it's commonly seen or heard that to get more returns, you need to take on more risk. Isn't that right? We know this already. And many of us do this. They move away from the traditional fixed deposits, which barely gives us good returns. It hardly beats the inflation. So, whether you like it or not, it becomes very, very clear and it's obvious for any investor who wants to get more returns would move towards riskier investment options. Now I understand that we do allocate a certain portion into riskier assets while we allocate some of them into safer assets like bonds, just to minimize the risk, just so that we do not eat away all of our capital, just in case any mishap happens. When the market turns south, the bond portfolio would give us the cushion. It would still earn but experience less volatility. Or we have also seen people investing in other types of asset which goes in an opposite direction to the market, like gold. It's often seen that when the gold prices rise, the stock market falls. Or it's vice versa, like I would say when the stock market falls, the gold prices goes up. But this is true. I am not saying we should not invest in bonds or gold or any other asset classes apart from the stock market. We should. That's for sure. That gives a healthy diversification. But the portion that we have in the stock market, can we have a good mix of assets within that to generate the maximum returns? Yes, we can do that. So what does this scenario tell us? It gives us two important fundamental assumptions. Number one, you cannot view your assets in the portfolio in isolation. You just can't do that. Instead, you have to view them as one related to the other, both in terms of risk and returns. So, when you look at your portfolio as a whole, you can then select assets that have different returns and are not correlated. Why? So you can balance the risk of each other. And number two, the second most important assumption is it is very, very difficult to forecast the future returns. Yes, we do look at the historical data of assets and the returns that has given to the investors, but we can guess the range of return an asset class can give to an investor. We cannot be specific. We can definitely gauge or maybe get a glimpse of the range of returns that you can get from a particular asset. So with these principles in mind, you can proceed to craft different portfolios for yourself which would have different risk and returns. Now let's try this with an example. Now consider this portfolio. You have a portfolio, you're preparing a portfolio mix which has a fund A and a fund B. Now you're putting in 70% of your money in fund A and 30% into fund B, and you expect returns of around 7% from A and 10% from fund B. If that is so, let's see the expected value of the equation. The expected value of your portfolio would be the fund A would generate 70% of 7% returns. So 70% of 7%, which is around 4.9%. Now the fund B, which has a 30% allocation and it generates 10% return, this would give an expected value of the equation as 0.03. So what is the portfolio return of this mix? If you have 70% in fund A and 30% in fund B and the returns are 7% and 10% respectively, the portfolio return of this mix would be 0.49, which is the expected return for fund A, and 0.03, which is the expected return for fund B. So they add up to give you 0.079, which is 7.9%. So the expected return of your portfolio is 7.9%. So now we have seen how you can calculate the expected return of your portfolio. If you have a mix of portfolio into fund A, fund B, or at the asset class A, asset B, and you know the expected return of an asset A is somewhere around 7-8%, or asset B would be somewhere around 10-12%, you know how to calculate the expected return of your portfolio mix. Likewise, you can have your portfolio mixed up into different kind of assets. It's not just two different funds or maybe two different asset classes. It can be into multiple asset classes. And likewise, you can calculate the total expected return of your portfolio. This was part 1 in this calculation. Now let's see what is the standard deviation of your portfolio mix. Well, the standard deviation is a huge boring formula. I'll not get into the details of calculating this as to how we can calculate the standard deviation. You can get the numbers from different websites, but for your portfolio mix, for your particular portfolio mix, this is how you can calculate. This is the formula which you use to calculate. This is the formula that you use to calculate the standard deviation of your portfolio. That's a boring formula. But yes, we can calculate this. It's very easy. But do let me know if you want me to make a separate video on this, because this would take a little bit of more time. And if I include this in this video, it would be very long. So do let me know. Hit the like button and just mention in the comments that you want me to make a separate video on calculating this formula. And I'll definitely do this for you. So now, for your portfolio, you have one value as the expected return. You have the other value as the standard deviation from that boring formula that I just showed you. You get a number for both these equations. Now you have to plot a graph. You have to plot a graph with standard deviation on the x-axis and the returns on the y-axis. You see this yellow dot? We have plotted the standard deviation on the x-axis and the returns on the y-axis. And the value that you get out of those two equations is plotted on this yellow graph. And likewise, this is just one spot on your portfolio mix, Now if you want, but what if you say, okay, fine, I do not want this. I can construct a different portfolio. I can take on more risk. I have more risk appetite. It's fine if I can take on more risk. Let me create a different portfolio mix. How would that look like? How would a different portfolio's expected return and the standard deviation would look like? You would have a different number, definitely. You would have a different number for the expected returns. You would have a different number for the standard deviation. And if you plot those numbers again, you will get another yellow spot somewhere on the graph. And you say, no, fine, I'll be more safe. I cannot take on more risk. Fine. You put majority of your funds in a safe asset and put in little of your fund into riskier assets. You construct a different portfolio. You have a different set of returns and standard deviation number. You plot them, you plot that in the graph, and you get another yellow spot. Likewise, you can construct multiple yellow spots on that graph. Go ahead and make different portfolio combinations as per your risk appetite and start plotting them on this graph. As many portfolio combinations as you would like. As many as you would like. You can have 10, 20, 30, 40 different portfolio combinations, and you can plot all those 40 points into the graph and see how it looks like. And see, when you've plotted these 40 or 30, 40 different portfolios for yourself, and you see there is an edge beyond which you will not find any of your portfolio combination mix. Okay? So this edge line that you have, you can draw a line, you would see it'll look like a parabola. It looks like a parabola. This is called the efficient frontier line. And any portfolio on this line, or touching the line, or maybe it's just crossing the line, or maybe nearer to this line, any portfolio mix that you see here, this one, probably this one, all of these would have the maximum returns as per the risk that you have undertaken. So for the standard deviation, this is the maximum returns that you would get for this portfolio, this yellow portfolio. This is the maximum returns for the standard deviation that you have taken for this portfolio. For the amount of risk that you have taken for this portfolio, this is the maximum return you can get. Okay, so any portfolio falling along this line, along this parabola, would give you the maximum returns for the portfolio mix. So you see, any portfolio on that parabolic line would give you the maximum returns for the risk that you have agreed to undertake for that portfolio. This is called the efficient frontier. And if you can calculate the risk, the standard deviation, and the expected returns for your portfolio mix that you have sort out for yourself, for the amount of risk appetite that you're willing to undertake, you can maximize your returns. That's all for today. In the next video, we'll come up with the part 2 of maximizing your returns. So stay tuned, like and subscribe this video so you do not miss when part 2 comes out. Thanks. Have a nice day. See you again in the next video. Till then, SC signing off. Goodbye.